Edward Brown, host of the Best of Investing, here to remind you to tune in this week on Saturday at 8 p.m. Our guest is going to be Jerry Thompson of Integrity Electric to talk about wall panels from Tesla. This ought to be very interesting. You're not going to want to miss this show. That's the Best of Investing on Saturday at 8 p.m. Welcome. You're listening to The Best of Investing. I'm your host, Edward Brown. Our phone number is 888-912-1190. Use that number to answer the trivia questions for a 5-pack tanning certificate given away during this show. That certificate is not sponsored by the radio station, but by Tan Bella Tanning Salon with 2 locations in San Francisco and 1 in Marin. And because tomorrow is the Super Bowl, that's our trivia theme is the Super Bowl. Now, today we do have a special guest, Ben Fraser of Aspen Funds, which is specializing, I guess you specialize in investing in oil and gas in today's market?
Yes, sir.
Does that sound about right?
Yeah.
Okay, good. So I'll give a little background here. Ben is the Chief Investment Officer at Aspen Funds, an Inc. 5000 company, and is responsible for sourcing, vetting, and capital formation of investments. Mr. Fraser has prior experience as a commercial banker and underwriter, as well as working in boutique asset management. Ben is a contributor on the Forbes Finance Council. He is also co-host of the Invest Like a Billionaire podcast. Hey, Ben, welcome to the Best of Investing.
Hey, thanks for having me out. We're looking forward to it.
Good. All right. So let's start off with this. First of all, what's going on in the oil and gas market? Because, the government seems to be wanting to shut everything down, supposedly.
Yeah, and as we speak, Biden just, made a pretty big unilateral decision to shut down more permitting for LNG facilities, and definitely some political pandering. But it's interesting what's going on, and we can kind of break it down. But yeah, so oil and gas is one area that we focus on. We have a lot of real estate in investing as well, and so our focus is to look at where do we see opportunities across the economic landscape that are not currently well understood or can play out over a long period of time. We can position ourselves and our investors into these opportunities. And so oil and gas is one of those that we think has a lot of potential to the upside, but it's actually still pretty attractive even in the meantime while the current dynamics are going on. So happy to break it down as you like.
Sure. Okay. So your fund, is it one of those like 506 Reg D type funds?
Yeah, exactly. So everything we do is for accredited investors, and it's all private. So these aren't publicly traded investments. These are private direct investments into in this case oil and gas properties or working interests, or in real estate into the actual real estate itself. So you get some great tax benefits being able to invest directly into the assets versus a publicly traded vehicle.
Depletion allowance, right?
That's right. That's one of the great ones.
Yeah. In what I read in the beginning, it says that Aspen Funds is an Inc. 5000 company.
Yeah, so the Inc. 5000 list, it's basically a list of the fastest growing companies in the U.S. So we've been on there for, I think, 3 years or something. And been growing a lot. So we've raised about $200 million from investors, just everyday accredited investors over the past few years, and continue to grow.
Wow. The one interesting thing about this, doing oil and gas as an investment, you can, go into further on this, unlike regular real estate where you get, depreciation, which, the commercial is 39.5 years and residential is 27.5 on just the building, not the land portion. Oil and gas has its own special tax benefits, right?
It does. Yeah. So there is depreciation because there's equipment. But you also get depletion, which you already mentioned, and another very similar kind of non-cash expense that you can write off against your taxes. And so basically the idea is oil and gas is different than real estate in that it's a depleting resource. So as you're pulling oil and gas out of the ground, there's less of it in reserves, and so you're reducing the value of the asset over time. And so there's an allowed depletion expense that you can take. But there's also acceleration in a lot of these cases. And when you're drilling, the real big tax benefit in oil and gas comes from drilling. So intangible and tangible drilling costs are pretty awesome. I mean, you can write a significant portion of those costs off in the year that they are incurred, and so it's a pretty very tax friendly investment vehicle, which is funny given how
Yeah.
political it's become and the ESG movement, and
Yeah.
the as much as they want to shut it down, they still haven't changed the tax code. So
Yeah, not yet, at least. And we'll get into the numbers in a little bit because I'm kind of curious, and I'm sure some of the audience is curious. Like, if someone invests $100,000, if they qualify as an accredited investor, what what kind of tax benefits they get. And we're going to go to our first commercial break here. Before we do, I do want to make a mention here for iTex Funds, it's not funds, iTex, which is a company that does barter. And it's really cool because it's on the up and up with the IRS. They give you a 1099, and if you're an electrician, you can put your work into it, get credits, and use it for something else like Giants tickets here in the Bay Area, or you might be able to use a plumber or a CPA, anybody who's part of the system. So it's a great way to do business without using real cash. Check them out, iTex, ITEX. They're actually international, so it's all over the place. It's good company. All right, here's our first trivia question. What player has been in the most Super Bowls? And bonus, just for ego bonus, how many Super Bowls? All right, call 888-912-1190. The first caller with the correct answer wins that tanning certificate, which, by the way, is worth over $100. What player has been in the most Super Bowls? And how many? All right, stay with us. You are listening to The Best of Investing. Don't touch that dial. We're going to be right back. Welcome back to The Best of Investing. I'm Edward Brown, your host, along with my special guest, Ben Fraser. Our first trivia question on the Super Bowl. What player has been in the most Super Bowls and how many? Ben, you know the answer?
I don't. I'm sitting in front of a computer and I resisted Googling it because it's a great question. I got to go with Tom Brady because I know he's won the most.
Yeah,
So I'm going to go with
that
that.
is correct. He has been in.
Okay.
He's appeared in the most. Any idea how many he's been in?
Oh, 8. That's my guess.
9. Not bad.
9.
And I think
Okay.
he won 6, if I'm not
He
mistaken.
won 6. I knew he lost a
He won
couple.
6.
So
Yeah, he lost a few, but that's not bad. Okay, all right. So Ben, I'd like, before we get into all these other kinds of questions that you had for me here, if someone invests $100,000, now the thing is, your fund, did you say it does more than just oil and gas? The specific fund, or is it just oil and gas?
so we have lots of different funds. So like I was saying before, the way that we approach investing is really from a top down, or we call macro driven perspective. So we're looking at different opportunities. We have opportunities in private credit, which is basically lending in real estate. A lot of unique opportunities there. We have a lot of development opportunities. We're very big believers in industrial, for example. And then oil and gas is kind of the other big vertical that we're focused on.
Gotcha.
And so our fund in oil and gas only invests in oil and gas properties.
Gotcha. Okay.
We have other things as
You
well.
have other funds. Yeah, it's like at Pacific Private Money, we have lending funds, and then I manage a fund that we buy discounted notes. So a little separate, still in the lending facility, but it's a little bit different. So let's focus in just for now on the oil and gas one for a minute. So if somebody invests $100,000, generally speaking, from day one, what is their K1 going to look like?
Yeah, so there's a lot of different ways to invest in oil and gas, and I think this is where some people get a little bit nervous and maybe don't feel comfortable because they've heard the horror stories. And there is a lot of there's different ways to invest, right? And so most people are familiar with, and what's usually most attractive from a tax standpoint is investing in just pure drilling programs. So that's where you're going and either pooling capital together and you're going and wildcatting, right? You're going to go just hope you hit oil. And by doing that, you get the most beneficial tax write-offs, but you also have the most risk. And so if you hit oil on a couple of your wells, then maybe you can recover your money plus some profit. But if you don't, then, might be a capital loss. And so it's a big kind of risk reward trade-off. From our approach, we don't really want to do that. That's not necessarily bad if that's your kind of cup of tea, but what we focus on are buying existing producing properties and leveraging the cash flow that those are creating to then reinvest in new drilling to kind of layer in some of that upside from the new drilling. And so the cool thing right now, and kind of why it's such a great opportunity, is because a lot of capital has left the space because of these ESG mandates, right? Environmental, social governance mandates that are being pushed not only on the operators, but also on the capital allocators. So these big private equity funds have left the space. And so they are not allocating to oil and gas because they get penalized and their scores go down if they do. And so it's actually created a big vacuum of capital. And so you can purchase existing producing properties at pretty incredible rates of return. So, for example, we're buying the past few purchases we've done have been about a 20% cap rate or 20% unlevered cash on cash yield. So that's just without any debt. We're buying the production and we're getting 20% rate, IRRs, and we can leverage that cash flow back into drilling. And these are infill drilling, so it's in areas of well-known geology. It's not wildcatting. It's they've already drilled 1,000 wells, just one more, and usually hit about a 50% IRR on average when you do more drilling. So you kind of layer in that. Rates of return on an annualized basis, usually over 20. We're targeting,
and that's separate from the tax benefit. That's cash on cash, so that's separate from the tax benefits. So
exactly.
So because I remember back, I think I'm probably a lot older than you. I remember back in the late 70s, they had to come up with these rules called the at-risk rules because people were doing these tax shelters, not just oil and gas, but tax shelters. They weren't at risk for this borrowed money, and it was a no-brainer, risk-free return because you'd invest $100,000, you get $150,000 worth of credits on your tax return. So even if the thing blew up, it didn't matter because you made a 50% return on just the taxes that you didn't have to pay. So then they came up with the at-risk rules and they changed things a bit. Gosh darn it, we're going to get into another break here really soon, but because I want to find out, like, again, if someone invests 100,000, generally what would their K1 look like just from the tax standpoint? Because even if they get $95,000 of worth of credits, then they're only at risk for only $5,000. So I'd like to kind of get into that when we get back. All right, we're going to cut to our second commercial break here. Do you want to make a mention here for Mountain Mike's Pizza in San Rafael? Pizza the way it ought to be. And since tomorrow's Super Bowl, you better get your order in soon because you got to know that. What do people do? What do they eat on Super Bowl? Lots of pizza. Lots and lots of pizza. So check them out. They do pizza the right way. Mountain Mike's Pizza in San Rafael. All right, our second trivia question on the Super Bowls. What team played in 4 Super Bowls but never led with points at any time in the game? So they played in 4 Super Bowls, but they never led at any point in time. Call 888-912-1190. First caller with the correct answer wins that tanning certificate, again, which is worth over $100. I'll ask the question one more time. What team played in 4 Super Bowls but never led with points at any point, at any time in the game? All right, stay with us. You're listening to The Best of Investing. Don't touch that dial. We're going to be right back. Welcome back to The Best of Investing one more time. I'm Edward Brown, your host, along with my special guest, Ben Fraser. Second trivia question. What team played in 4 Super Bowls but never led with points at any time in the game? I thought was pretty amazing.
That is, it's kind of a sad stat. I'm going to guess Detroit Lions.
Well, they've never been in the Super Bowl. So can't be them.
Well,
Can't be them. The Minnesota Vikings.
Oh
They've
man.
been they've been
Okay.
in 4 Super Bowls. They've lost all 4, very similar to the Bills. But at some time, the Bills were ahead of the
We're
Cowboys,
ahead. Okay.
yeah, and the Giants at one point. But no, the Vikings. That's pretty sad. Okay, so again, kind of going back to my question before. Generally, what would a K1? If someone invests $100,000, the first year I think is the best year, isn't it, for the tax benefits? Okay, for the investment in tangible drilling costs, et cetera. What generally would their tax return or their K1 look like?
Yeah. So I'm not a CPA. I got to give all the caveats, right? This is
Of
purely
course.
informational
Yeah.
and all
Yeah.
that. But it's a little hard for me to say concretely, but I'll give some just trains of thought of how you think about it.
Just rough
For us,
ideas. Yeah.
it's going to
Yeah.
be less driven from the tax benefits because we're actually
Okay.
producing so much cash flow, right?
Oh,
So when you're
gotcha. Yeah.
doing a pure drilling program investment, you are going
Yeah.
to get the big write-off because you don't have any production, no cash flow, and you get that.
Yeah.
A lot of times you
Gotcha.
can write off a pretty significant portion. In our case, we're producing so much cash flow
Yeah.
that the benefit usually won't impact the capital account, but it will
Okay.
impact the majority of the cash flow being generated. So it would be a tax
Gotcha.
deferred rate of return, which is also still
Yeah. Yeah.
attractive, but it's not the pure drilling. So that's
Yeah.
where I was saying earlier the difference is there. You can get some nice benefits,
Sure.
but you also have the higher risk with
Higher
do you
risk.
hit dry holes or not.
And with is there a certain price that oil needs to be for you guys to be profitable?
Yeah, break even oil price is usually somewhere in the 40s, 30s,
Okay.
40s. So these are generally horizontal wells. So these are large scale. We're partnered with large operators. So on our first few acquisitions, we have 8 different operators, 5 of which are publicly traded. So there's they are able to drive down costs, create economies of scale, a lot of efficiencies,
Sure.
and that's usually the break-even price. Well, right now we're in the mid 70s as
For
we
you.
speak,
Yeah.
and it's a pretty nice profit margin at that point. But we think there's a lot of room to the upside. A lot of predictions are making cases for above $100 for kind of the new
Yeah.
normal over the next several years.
What was crazy was during COVID. I don't know how this happened, but oil went like negative $37 a barrel. I mean, what I don't even know if you could have bought it down that low, but what happened?
Yeah, it was
All the
really, really
contracts were thing.
fascinating. There's a lot of things that went going on there, but yeah, for one day, the price of oil went negative. So basically, if you produced oil, you had to pay the midstream company to take it away from you, right? So that's usually not the direction of cash you want to see. But there was a very different environment there, and really in that era, they were pumping a lot of oil, and so there was a lot of investment, a lot of supply, and the supply kind of flooded the market. And it was kind of more of a fluke at the financial markets that it went negative.
Yeah.
That's obviously never really happened, and it didn't stay negative. It was
No.
like that, but it was the price of oil was suppressed. But what's happened since then is really why the thesis that we're so interested in and excited about is if you think about oil and gas at a broad level, because it's a depleting resource, every year we deplete about 5% of global production just
Really?
by using it. And so by nature, we have to continue investing in new production through exploration and
Uh,
drilling to just maintain the same level of supply. And what we've seen over the past about 9 or so years is a 50% drop in investment in new production, new exploration. And so it basically spells out, future supply will be much, much lower. And JP Morgan just released a report recently that they expect by 2030 a 7.1 million barrel per day shortfall globally for oil that if there aren't huge changes in investment and supply will not be able to be solved. And so, most people
yeah.
think, oh, we don't need oil anymore. We got renewable energy. Right now, renewable energy only makes up 17% of global energy
I know
production.
I mean, I
There's no way
definitely subscribe
we're gonna
to.
transition in the next 4 or 6 years.
I mean,
And
I
so
subscribe
there's
to
really
more
kind of we believe a
conservative.
green energy crisis.
Yeah. So I kind of watch a little bit more on the conservative news side, and I tend to believe a little bit more what they say because it seems kind of ridiculous that we're cutting back our production, like with the Keystone pipeline and all that, but yet we ask Venezuela for oil, which is dirtier oil than me than the United States. It's like I don't. That doesn't make any sense. I mean, so if we do all this green energy stuff, but then China and India and all those places produce all this pollution, what are we doing? Saving half the planet? I mean, it's to me, it's totally ridiculous. And I heard something recently, like with these global temperatures, where they were putting the thermostats was like on like hot roofs and stuff to manipulate the data. And I does to me that it doesn't surprise, nothing surprises me anymore. Kind of crazy. When we get back, I do want to ask you about this ESG movement and how that's creating opportunities for oil and gas, and then what's going on currently in the energy market. So here's our third trivia question, and time goes fast. Okay, we're talking about the Super Bowl. What current teams have never made it to the Super Bowl? So teams that are currently in existence now. And you can't say like the 1943 Steagles because that was a combination of the Eagles and the Steelers because that doesn't exist anymore. Call 888-912-1190. First caller with correct answer wins that tanning certificate. Stay with us. The Best of Investing. We'll be right back. Welcome back to the Best of Investing. Edward Brown, along with Ben Fraser, my special guest here at the Best of Investing. Okay, here's our third trivia question about the Super Bowls. What current teams have never made it to the Super Bowl? Go ahead.
Okay, well, I think I gave one away with the Detroit Lions.
You did. The Detroit Lions is one.
But outside of that, oh man, it's hard to know. New York Jets.
No, they won with Joe Namath, Super Bowl III.
Okay. Yeah.
Well, I'll give you the answers. The Cleveland Browns.
Okay.
So they've won championships, but that was before the Super Bowl era. And then the two more current teams, the Houston Texans, which used to be actually no, I was going to say that. Oh no, yeah, that's right. Because the Houston Oilers became the Tennessee Titans, and they did make it to the Super Bowl. But so the Houston Texans and the Jacksonville Jaguars have not made it. Okay, let's see. So Ben Fraser, we're talking some oil and gas here. So first of all, this ESG movement you mentioned is creating opportunities in oil and gas. Why is that?
Yeah, I've touched a little bit on some of the things that are going on, and it's been happening for a little bit, but it's kind of become pretty acute, right? We just mentioned earlier, Biden just is trying to pass the ability to ban more LNG export facilities, and it's just political pandering at this point, right before the re-election to the hardcore left that wants the green energy. And I think what's challenging is we all want renewable energy, right? That's a great goal we should achieve, right?
I mean, who's against sun?
But
the sun
the
from
challenge
solar
is the transition to get to that point.
Yeah.
And the goals and benchmarks that they've set and the time frames are completely unrealistic. And so
also, isn't it bad for the environment to do all the cobalt
narrative that is now created this whole expectation that's not going to happen? And so what's happened is the capital allocators are not allocating to oil and gas. They're actually getting penalized from I mean, John Kerry is going around telling banks don't lend to oil and gas companies. Well, we're just shooting ourselves in the foot because what are we going to do in 10 years from now? We don't have the supply, and guess what? Demand is actually predicted to increase over the next 10 years. Right? So by most estimates, even the most left-leaning agencies that are promoting the green energy the most still have a hard time arguing demand's going to go down, right? Because from population growth, from continuing to have more transportation, and this is in the U.S. And so there's increasing demand and then there's decreasing supply. We all kind of, know basic 101 economics here, and it's inelastic. You can't just
Yeah.
flip a switch and all of a sudden turn on more production. It's a multi-year investment, exploration, production, building infrastructure, and delivering it to the market in a refined way.
Yeah.
And there's just so many components of this that take many years to get to market, and we're not seeing that investment. And so why we think it's a good time to buy right now is, well, one, oil is actually, still at a good, mid 70s. It's a good oil price. You're
Yeah.
still making good returns, but it's not a crazy oil price to where a ton of people are jumping in. And so we can actually buy these assets at really good cash flow streams, like I was mentioning earlier. Buying these at a
Yeah.
20% present value, which is similar to a cap rate. And it's just good value, even if oil prices don't go up.
But let me ask you though, because the depletion, the fact that it is a non-renewable source, it's constantly depleting. So someone invests 100,000, basically they'll get. Let's make it simple. If the cap rate's 20%, they'll get $20,000 a year, right?
Mhm. Yep.
Okay, but for how long? Do they
Yep.
ever get their $100,000 back, or is it just they'll get 20,000 a year for let's say 15 years and get nothing back?
Yeah, well, at a 20% return on equity, you're getting paid back in 5 years, right? So, most of these assets we're investing in, like I said, they're horizontal wells. So these are institutional, they can go for miles and miles. They're in great basins, and they have a lot of high initial production, right? So there's like a big
Yeah.
initial surge of production, so that cash flow can be higher earlier on. And then, yeah, it drops off, but they usually stabilize, and they can last for usually many, many decades. So the payout may go down over time, but it's not, you 2 years down the road, you're done. So it's
Okay, so
usually,
theoretically, of that 20,000, some of it's a return of capital. We just don't know how much.
yeah, and we leave
Okay.
that for the accountants to figure out.
Yeah. No, but I mean, you can put it. I mean, it's not necessarily bad. I mean,
Yeah.
because you can, if you're going to get 20,000 for the first 5 years, and then you're going to get 18,000 the next 10 years, and then you're going to et cetera, et cetera. You can put it on a present value calculator or computer, and it'll tell you what the rate of return is. So it's like an annuity, a depleting
Exactly. And so
annuity.
that's what I'm
Yeah.
saying, present value. That is actually modeling out the decline curves of the production,
Yeah.
normalizing it to a present value today, and it's about 20%.
Okay. And then if there are some tax advantages, that just boosts the yield that much more. Before I forget, Ben, how do people get a hold of you if they are interested in oil and gas type investments?
Yeah, our firm is called Aspen Funds. You can go to aspenfunds.us. That's our website, and a lot of information on there.
Okay. What are the most important due diligence items to pay attention to?
Yeah, I know this could be a whole chat in and of itself, but
Because we have
it,
about
it's
we have about a minute and a half on this. Go ahead.
okay. I'll keep it quick. So I mean, it's kind of funny because there's a lot of what I would say bad actors that for some reason this
Mm.
industry attracts, and there's just kind of a sense of, when we first got into it several years ago, someone said, the definition of oil and gas investing is a salesman or a liar on top of a dry hole, right? And it's just that's the kind of expectation going in. But we've since learned a lot along the way, and there's a lot of things you can look out for. But the foremost being track record. Make sure you're actually verifying production. This is reported to
Yeah.
municipalities. It's actually public knowledge. There's a lot of things you can do to kind of check the boxes there.
Okay, that's fair enough. And economists and investment bankers, what are they predicting for oil prices? It's funny. I mean, I think about like what you said about John Kerry, and my first thought is, yeah, well, you know what? If you really believe all that stuff that you preach, stop going in an airplane that does the carbon footprint 100 times more than the rest of us, and telling banks not to lend sort of seems like a lawsuit waiting to happen because they're interference in business relations. If I were an attorney, I might want to look at that.
Yeah, no.
I mean, I'm not sure what he's and that's this whole thing about the green energy. People don't look at like the child slave labor for the cobalt for the batteries, et cetera, et cetera. I mean, it's so manipulated that they get you to think whatever they want you to think. Tell you what, Ben, give out your information one more time, and then we're going to cut to our break, and we're going to come back with some closing comments.
Yeah, thanks. It's Aspen Funds, ASPENFUNDS.US.
Very good. Stay with us. The Best of Investing will be back with some closing comments. Welcome back to the Best of Investing. Last time for today, I'm Edward Brown, your host, along with my special guest, Ben Fraser of Aspen Funds. It's been very interesting learning about this oil and gas. Now, at Pacific Private Money, we are doing mostly just strictly lending, mostly residences. We do some commercial? I manage a fund that buys discounted mortgages, first mortgages, primarily on residential housing, because our attitude is everybody needs a place to live. And no matter how bad things get, my wife will not let us move into a tent. We might have to downsize, but she won't let us live in a tent. So our fund right now, our average loan to value is about 54%, but because we're buying these notes at a discount, it's less than 37%. So, a house that is worth $100,000 where the borrower owes $54,000, the borrower still has a fair amount of equity in the house, but we bought that loan for $37,000, but they owe us $54,000. So we have a lot of protection. We just pay out a flat 8.5%. And we are going to start introducing potential for a 12% return if people can get a deferral rather than get a monthly check. If they're interested in a deferral, then we'll pay them up to 12%. Again, you have to be an accredited investor. Main reason we're doing that is that there's a lot of profits to be had in these discounted mortgages, and it's a way for clients to invest in it. But we never know what happens with these mortgages from the standpoint of day to day, because a lot of them may be non-performing, and we're lending against the assets, and the company that's controlling it, they will either work with the borrower to do a workout loan, or they'll foreclose on the house. In either case, there's a lot of profits to be had, and it's one way to kind of share in the profits. But that would be a up to 12% deferral for up to 2 years. We're working on a schedule now to see what happens if people only want to be in for a year. I don't know what the rate is yet. People have to call me, 415-883-2150. But again, our Southwest Fund buys discounted mortgages, pays out monthly, 8.5% annualized return. Very, very conservative loan to value. In fact, I've been in this business for a very long time. I don't know of any other fund that's this conservative. Now, I do have a bias because I am one of the managers, but I try to be very picky as to what goes into this fund. So, but anyway, if you're interested in oil and gas type investments, then you can call Ben or get in touch with Ben Fraser at Aspen Funds. And Ben, we're going to have you on again because there's a bunch of more questions here that we could have gone over. And like you said, for going into not only the ESG a little bit more, but what are the economists talking about, and all the trends with oil and gas. Things change quite a bit, so I'm sure it'll be very, very interesting to revisit oil and gas. And it's funny because the first time when I got my Series 7 license back in 1983. Petro Lewis was a big operator, and they had problems because oil went all the way down to, like $9 or $10 a barrel from $25 or $30 a barrel. And so they had problems, but I don't see these, oil prices going down too much. So I think Ben's right that, staying at 70 something dollars a barrel is probably about where we're going to be or higher. And if you can make money at $70 a barrel, that's not a bad way to go. All right. All right. So now we're going to cut to our thoughts for the day. Ben, you're going to like these thoughts. You ready? Here we go. All right. So I had a job selling security alarms door to door, and I was really good at it. In fact, if no one was home, I would just leave a brochure on the inside table, right on the kitchen table inside. And one time a cop pulled me over and said, "Papers." I yelled, "Scissors," and drove on. Come on, that joke rocks. All right, so audience, tune in next week to the Best of Investing. We're going to be giving away more free prizes for answering trivia questions, and of course, having more dad jokes. That's the best part of this show, Thanks for listening. On behalf of our team, I'm Edward Brown, wishing you the best of investing. So long.